welcome to the deep dive. You've brought us some really fascinating source material today, a deep look into a very specific long-term strategy for building a dividend portfolio.
That's right. And the core goal laid out here is pretty compelling, isn't it? Building a $100,000 dividend portfolio over about 15 years,
Okay.
with the potential to eventually yield, get this, 10.75% on your original cost,
Wow.
generating, over $10,000 in annual dividend income.
$10,750 a year just from dividends on a $100,000 investment.
That sounds amazing, but the material is very clear. This isn't some kind of get-rich-quick thing.
Not at all. No magic pill here. It's explicitly described as get rich slow, done right.
Get rich slow. I like that.
Yeah, it's all about long-term commitment, patience, compounding, not chasing fast gains.
Okay, let's dive in then. Our mission for this deep dive is really to unpack the core ideas, the strategy, and the practical steps outlined in the material you've shared. So what's the absolute fundamental concept we need to grasp first? It really all hinges on understanding one key metric: yield on cost, or YOC for short.
Okay, yield on cost. Now, I know yield is usually like the dividend divided by the current price. So YOC must be measuring something different.
Exactly. Standard yield uses the stock's current market price, which, is always bouncing around.
Right.
YOC, though, is calculated by taking the current annual dividend and dividing it by your original purchase price for that stock, your cost basis.
Oh, okay. Because your purchase price is fixed, locked in when you buy, but the market price is always changing.
Precisely. And that difference, that's really where the strategy finds its power. Let me give you the example from the material. It makes it clearer. Imagine you buy a stock for, say, $50 a share.
Okay.
And it currently pays a $1.50 annual dividend. That's a 3% starting yield, right?
Yeah.
With $1.50 divided by $50.
Yeah, standard calculation. Got it.
Now, here's the key bit. If that company is solid and it consistently grows its dividend by, let's say, 10% every single year over 15 years, that $1.50 dividend doesn't just edge up. It compounds. It would actually grow to $6.27 per share annually.
Wow, that's more than 4 times the original dividend payout.
Right. And this is the punchline. Your yield on cost, your YOC, would then be that $6.27 divided by your original $50 purchase price.
Yeah.
Which comes out to an impressive 12.54%.
12.5% on my original $50.
Exactly. That's the sort of magic this approach is trying to capture, growing your yield relative to what you paid over time by owning companies that reliably hike their payouts. It's not about chasing the highest yield today.
So it really flips the script. It's not about the yield flashing on the screen right now. It's about the yield you build over years on the price you locked in way back when. That totally changes how you look at a stock's income potential.
It really does. And that's precisely why the material you provided calls dividend growth the rocket fuel for this whole strategy.
Yeah, and it seems to warn pretty strongly against just grabbing those stocks with like double-digit current yields. Calls them traps.
Absolutely. Big caution there. Those super high current yields, often over 10%, can frequently be traps, unsustainable payouts from companies that might be struggling, meaning a dividend cut could be coming.
Right. Makes sense.
So this strategy says instead, look for companies that might start with a more modest yield, maybe in the 2% to 4% range.
Okay.
But crucially, have a strong track record and the potential to grow those dividends consistently and significantly. Think like 8% to 12% growth annually.
And the numbers really back that up, don't they? The material shows how different starting yields plus strong growth can end up in a similar place. Like a stock starting at 2.5% yield but growing at 12% a year could hit over 13% YOC.
Yeah, or a 3% starting yield growing at 10% gets you past 12.5% YOC.
Even a 4% starter with 8% growth still gets you almost 12.7% YOC. So it's really similar outcomes. It's fascinating, isn't it? The rate of dividend growth, the velocity, often ends up contributing more to that future YOC than the initial yield number itself. You're looking for businesses built to just reliably hike those payouts year after year. That's what powers the compounding on your original cost.
Okay, so we get YOC, we get why dividend growth is the engine. How does the material say we should actually build the portfolio to do this?
It mentioned something about the 3 tiers.
Yes, it recommends a specific structure. A blend, really, designed for both growth and stability, divided into three main categories or tiers.
All right, first up is Tier 1, core dividend growth stocks. And that's the biggest chunk, right? 60, 70%.
That's the idea. These are positioned as the bedrock in the portfolio. Solid, blue chip companies you ideally buy and hold for the long haul. They typically have those lower starting yields we talked about, maybe 2-3%, but they're known for consistent, strong dividend growth. The material calls them the compounding machines.
So we're talking about companies like PepsiCo, Johnson & Johnson, Microsoft, Visa, Home Depot. Those names listed as examples. Big, stable businesses just cranking out bigger dividends each year.
Exactly. They form that reliable foundation. Then you move to Tier 2. High yielders with stability. This is about 20-30% of the portfolio.
Okay, this sounds like where you get a bit more income right away.
Yes, precisely. These provide balance with higher, but still relatively safe, yields generally in the 5-6% range.
Okay.
Now, their dividend growth might be slower than Tier 1, but they offer significant current income and stability. Examples mentioned were realty income. That's a REIT, pays monthly, which is nice.
Oh, monthly, yeah.
Brookfield Infrastructure Partners, Verizon, and Enterprise Products Partners, which is in energy midstream.
So dependable businesses, strong cash flow, enough to support that higher payout without stretching too much.
Exactly. You're looking for solid operations and, importantly, conservative payout ratios here, meaning they aren't paying out all their earnings as dividends.
Right, leaving some cushion.
Yeah, leaving room to maintain and maybe even grow the dividend, even if times get a bit tougher. They add that steady income stream without the high risk of just chasing any old high yield.
Okay, makes sense. And finally, Tier 3. Opportunistic plays, this is just 10%. Sounds like where you can experiment a little.
That's the idea. It's a smaller strategic allocation where you can potentially add a bit more return or different income types, but you keep it small so it doesn't, dominate the whole strategy. The material suggests things like maybe undervalued dividend growers you find, REITs that might be recovering from a downturn, turnaround income stocks, or even covered call ETFs like XYLD, which generate income in a different way using options.
So maybe a bit higher risk or less predictable, but you limit the exposure. It's just a small slice to potentially spice up returns without derailing the main plan.
Exactly. It's the spice, like you said, not the main course. And the material actually provides a sample $100,000 portfolio allocation just to show how these tiers could work together in practice.
Right, and it's crucial to remember that's just one example mix, not a prescription, but it shows the blend. That sample portfolio, it starts with a current yield of about 4.85%.
Which, like you pointed out, is way below that target 10.75% YOC we're aiming for eventually.
Yeah.
But the projected YOC in 15 years for that specific sample mix is indeed right around 10.75%. And if you look at the individual projections within that sample, it really highlights the power of growth on cost.
Like what?
Well, VCI, another REIT, was projected at something like 17.43% YOC. Home Depot at 12.74%, Brookfield Infrastructure at 12.45%.
Wowza. Those numbers really make that abstract YOC concept feel concrete. That's the potential income stream you're building on your initial investment dollars.
It absolutely is. Now, to actually get to that 10.75% YOC goal in 15 years, the material stresses a really critical, almost non-negotiable step.
Okay, what is it?
Reinvestment.
Reinvesting the dividends. Tell me more about that.
It states it very clearly. To hit that target, you need to reinvest every single dividend payment, especially for the first 10 years or so. Don't take the cash out, period.
So no using that dividend income for like lattes or impulse buys, huh?
The material literally uses that exact example. It strongly advocates using dividend reinvestment plans, or DRIPs. Calls them boring but effective.
Boring but effective. I like it.
And the benefit is simple but incredibly powerful. Every dividend payment automatically buys you more shares of that company, often fractional shares.
Right.
So this compounds your share count over time. You're often buying shares at various price points, including when prices dip.
Oh, yeah, good point. Buying low.
Which just accelerates the whole compounding process and builds a much larger income base for the future. The entire 10.75% YOC projection assumes this consistent reinvestment is happening.
That makes total sense. More shares mean more future dividends, which buy more shares. It's that compounding snowball effect. But okay, let's be real. Most people aren't starting with $100,000 just sitting there ready to invest.
True. Very true.
How does the material suggest building up that $100,000 portfolio amount itself over time?
That's a really important practical point, and the material addresses it. It provides figures showing how consistent monthly contributions can help you build towards that goal. It assumes a, reasonable 8% compound annual growth rate for the portfolio overall. That includes price appreciation and those reinvested dividends working together.
Okay, so if someone's starting from zero, what kind of saving are we talking about?
Well, it shows that saving and investing just $275 per month
$275.
consistently for 15 years could potentially get you to that $100,000 portfolio value.
Wow. Okay, $275 a month feels a lot more achievable for many people than thinking they need $100 upfront.
Exactly. And if you can invest more, obviously it speeds things up considerably. Like $550 a month could potentially reach $100,000 in 10 years, or about $1,300 a month might get you there in just 5 years.
Right. That really puts the goalposts in view. It becomes a target you can reach through disciplined saving, not just needing a huge windfall.
Absolutely. The key takeaway there is just start. Start now, stay consistent with your savings, and crucially, automate those contributions. Set it up so it just happens every month without you even thinking about it.
Make it boring, like the material says.
Make it boring. Discipline over excitement. That's the mantra.
Okay, so even with a solid strategy like this, there are always ways people can mess up. What are the big pitfalls the material warns us about?
Yeah, it highlights 3 main traps to avoid. The first one we kind of touched on earlier, chasing yield.
Right, getting seduced by that stock flashing a 12% or 15% current yield today.
Which, as the material reinforces, is often a massive red flag. It could signal real trouble. Maybe the company's struggling financially, and the yield is only high because the stock price has plummeted. A dividend cut could be just around the corner.
Yeah, the dreaded dividend cut.
So rule 1 is focus on quality companies and their potential for dividend growth, not just the current yield number alone.
Okay, pitfall number 1, don't chase yield. What's number 2?
Ignoring sector balance. Diversification.
Putting all your eggs in one basket, basically.
Pretty much. You might find a sector you really like, maybe tech or energy or healthcare, but if you overload your portfolio with too many companies from that same industry, you become really vulnerable.
Because different parts of the economy react differently to things like interest rate changes or recessions or consumer spending shifts, right?
Exactly. If you're way too concentrated, a downturn hitting that specific sector could really hammer your portfolio. Spreading your investments across different types of businesses provides resilience. It smooths out the ride.
Got it. Diversify. And the third pitfall?
Panic selling.
Ooh, yeah. When the market takes a nosedive.
And the market will have nosedives, it'll have dips, corrections, maybe even crashes over a 15-year time frame. That's just reality.
Sure is.
But the material frames this differently for an income investor compared to, say, a pure growth investor. Think about it. If stock prices drop 20%, but your quality companies keep paying and maybe even growing their dividends, your income stream might be totally unaffected. Or it might even increase if you're reinvesting those dividends at the new lower prices.
Right. Buying more shares for the same dividend dollar.
So the focus shifts. It becomes about the consistent income being generated, not the temporary swings in the market value of the shares themselves.
That perspective shift is huge, especially during volatile market periods. It makes those dips feel less like a disaster and maybe more like an opportunity for your future income stream.
Exactly. So if you manage to follow this strategy, you focus on quality growth, you blend the tiers properly, you consistently contribute, you diligently reinvest those dividends, and you avoid those pitfalls. What's the big payoff? Beyond just hitting that 10.75% EOC target, the material talks about the power of inflation-beating income.
Okay, how does that work? Connect those dots for us.
Well, it links that potential 10.75% EOC in 15 years to a pretty significant level of financial freedom. Consider historical U.S. inflation averages around 3% over the long term, give or take.
Right, around 3%.
If your portfolio is yielding 10.75% on your original cost basis, your real yield, that's the income you're generating above inflation, could be somewhere around 7.75%.
Wow, that's a substantial amount of actual purchasing power being thrown off by the dividends alone.
It really is. And the material suggests that with a portfolio yielding that much on your original cost, you might potentially be able to withdraw, say, 8% to 10% of the income generated each year in retirement, without necessarily having to sell the underlying stocks.
Just living off the income generated.
Potentially. Or, if you continue reinvesting some or all of it, you might never need to touch the principal value at all.
That is a powerful idea. Building an income stream that doesn't just keep pace with inflation, but significantly outpaces it, offering a path to potentially live off your investments without ever selling the golden goose, so to speak.
That's the ultimate vision, I think, of this disciplined, long-term, get-rich-slow approach. Building that income stream brick by brick while sleeping, as one of the sources beautifully put it.
I like that phrasing. The material also included a little bonus section, didn't it? A mini watch list and some tools.
Yeah, just a few examples of quality dividend growers that the source highlighted as maybe worth researching further. Names like AbbVie, Apple, Texas Instruments, Caterpillar, and Amgen.
Big names.
And it reiterates the core principle again there. Quality is everything. Don't compromise on the quality of the business.
And for actually digging into those or any other potential investments, it suggested some tools.
Right. Resources to help you do your homework. Things like fast graphs for visualizing financial data, Seeking Alpha for analysis and news, and Simply Safe Dividends for focusing specifically on dividend safety and growth metrics.
So tools to help you vet the companies yourself.
Exactly. It's about doing your due diligence before you commit your hard-earned capital.
Okay. So wrapping this all up, the final, overarching message from all this material seems to really center around time, not timing. Is that fair?
That's absolutely the core message. You don't need to be some kind of stock-picking genius who gets every call right. And you definitely don't need to try and time the market's peaks and valleys. Good luck with that anyway.
Right. Impossible.
So instead, you just need to start. You need to stay consistent with your contributions month after month. You need to religiously reinvest those dividends. And you need to patiently stay invested through the market's inevitable ups and downs.
Let the power of dividend growth and the magic of compounding time do the heavy lifting for you over the long run.
That's it. Patience, especially seeing those market dips not as disasters, but as opportunities to reinvest dividends at lower prices. That seems fundamental to actually achieving that potential 10.75% EOC goal in, say, 15 years.
Well, this deep dive has really unpacked the mechanics of this specific dividend strategy, focusing on quality dividend growth over just current yield, using that three-tier structure, the non-negotiable importance of reinvestment, and the power of consistent contributions. It really paints a clear picture of a very deliberate, long-term approach to building an income stream.
Yeah, it definitely requires discipline and patience, no doubt about it. But the potential outcome, that significant inflation-beating passive income, that's a powerful motivator.
It really is. So here's maybe a provocative thought for you, the listener, to consider based on everything we've just discussed. How might shifting your primary focus away from the daily, weekly, or even monthly fluctuations in stock prices, and instead focusing on the long-term compounding of your income stream, those dividends being paid out and reinvested, how might that shift change your entire perspective on investing, on building wealth, and ultimately on achieving your financial goals?
It's a really different lens, isn't it? Viewing the market through the lens of owning productive assets that pay you a growing stream of cash over time, rather than just assets you hope someone else will pay more for later.
Something to definitely mull over. And perhaps, explore some of those tools, or maybe look into a few of those watch list stocks mentioned in the source material you provided, just to see how these concepts look in the real world. This has been The Deep Dive.